Credit card defaults at record levels. Guys, this goes back to 1991. Guys, this is the great financial crisis right here. We're right here. We're at record highs and defaults. And it's weird because unemployment rate's very low still. And again, we had it here, and look what happened here. We had the recession here for COVID. But can this go on for a long time? Eventually, the banks are going to have problems. And you saw, look at the banks last year. We had Silicon Valley Bank go under. We had First Republic Bank, or whatever it was 2 years ago. And you sit there and say, all we're doing is masking this problem, kicking it down the road. This does concern me about the consumer. Now, does this mean you should sell everything? No. It just means be ready for volatility. Just be ready that things probably aren't as good as people think they are. The other things I always talk about is this. Look at the market. The top 5 companies in the S&P make up 28% of the S&P's value. Back in 2000, the top 5, and this was considered, the 2000 bubble was considered a very, very top-heavy bubble. All the big companies were overvalued. It was 15%, almost double. Now again, it doesn't mean go out and sell everything. You still have to stay with long-term ETFs, dollar cost average, because you don't know where things are going to go. This is not about putting fear in your mind to sit there and say the world's coming to an end. It's not. We go through cycles. I'm just the observer who says when things are really good, they're probably not as good as we think. And when things are really bad, they're probably not as bad as we think. Think about every recession we've had. It was always the world's coming to an end. And then guess what happens? Not bad things. Let me show you guys this chart that I found on Twitter one time that I absolutely love. I love this chart because this is the S&P going back to 1950 something. And these are all the awful things that happened along the way. All these terrible things that happened along the way. And there was way more than this. And this is a log chart. This is even the real chart for the S&P. The real chart in the S&P would look like this. This is a logarithmic chart, which I won't get into that. But the bottom line is this doesn't show the true growth of the S&P here. It might be real growth. I don't know. The point is, these are all the things that have happened that have been terrible. We have a big world. We have 8 billion people out there. There's going to be bad things happening every day. There's also going to be good things happening every day. And I'm going to ask you a question. What makes for better news? Good things or bad things? I really want you to understand this. This is the kind of mentality I'm trying to show and kind of relay on this channel. I know the fact that you're watching this video tells me you have the ability to understand this. That's what's important. Make sure you subscribe so you see all these videos because I talk about the emotion and mentality of investing so much because I realized in the last few years after having this channel and seeing all the emotional reactions people have about certain investments and going, yep, I used to think it was 80-20 financial understanding to emotion. It's flipped. It might even be more than that. It might be 90-10 emotion to financial understanding. You'll learn the financial understanding. Our tools and our software in our community will help you with the financial understanding. But the community will really drive the emotional part. Watching these videos over and over drive the emotional part. I'm currently working on a book right now. And that book is some sort of number of quotes that changed my life, where I take a quote and I write about how it changed me. I repeat these quotes all the time. My stepson's in the room right now. How many quotes do I send you I used to send you a ton of quotes. Why? Because I used to think quotes were cheesy, but it's about reiterating that emotional thought process in your head. It's about submerging yourself into that mentality, brainwashing yourself. If you can handle the emotions, you're going to be a successful investor. Absolutely. I recently went on Twitter and I sat there and said, and this is an emotional thing. It's also a lack of financials, but I said to everybody, hey, if you're 25 and I said, give me $50,000 and 40 years from now, at the age of 65, I'd give you $500,000. Would you be happy? 10x your money. The vast majority said yes. Then I told them, guess what, guys? That's 5.9% per year. The market on average has done 9 to 10% a year, which that 50,000 should then be $2.2 million, 45 to 47 times your money. But emotionally, you hear 10 times, you're like, yes. And yes, there is a lack of understanding of numbers, but we hear this and we go, this is awesome. This is what I want to teach you, that those extra percentage points can make a huge difference in your wealth. Those are the things that are going to make your life way more financially better. Can I say way more financially better? I don't know. But the bottom line is, guys, those fund managers are no different than you and I, but you have a better advantage over them. And I cannot repeat that I cannot say that more and more. I really want to repeat that over and over again. And when I look at what's going on in the economy right now and what people feel versus what they hear, I'm looking at going, listen, We're going to have a recession at some point. When I have no idea. We're going to have a stock market pullback at some point, probably a crash because of how overvalued we are. And we're going to hear it till we're blue in the face because it's easy to feel, it's fun to feel like you're part of the environment there. When you're like, oh, this person feels this person feels this, I'm in the crowd. But to really do well in investing, you just have to be a little bit different. And a little bit different can be as simple as you're not going to sell when everything seems scary. Morgan Housel says every past financial crash looks like an opportunity. Every future one feels like a risk. They're no different. They're no different. That's why I'm teaching the fundamentals of dollar cost averaging. And if you want to take part of your money and buy stocks, you have to be a different thinker emotionally. You have to sit there and understand that every investment is the present value of all future cash flow. And if a stock goes down in price, but the fundamentals are the same or better, that's an opportunity for you. If it made sense at 100 and the fundamentals are better, but the stock is 50, why are you not buying? Or if the stock has fallen 50% and the temporary pullback was 10% in fundamentals, why are you not buying? If it made sense at 100, why would you not buy at 50? That's what's hard to do. These financial managers don't do it. And to sit there and look at these consumer credit cards at all-time highs of delinquencies, what does that say about the world we're in right now? Is the consumer as strong as we think? Inflation's really hurt a lot of people. A lot of people were spending a lot of money on credit cards because of inflation. It's starting to show right here. Now, I'm not calling for a recession. I'm not calling for, I do think there's going to be a crash at some point. I just don't know when. What I'm saying is the future, the short-term 5 or 10 years of the market are not going to be like the last 5 or 10 based on every other metric I've seen in history that's reliable. Does that mean you should bail? No. Just be ready for it. That way, when it happens, you're able to view it as an opportunity. I hope you like what you heard. Subscribe to this channel. I do a lot of updates throughout the week. Thank you very much for your time.